The first thing I would say is it's not gold and silver going up so much. I mean, there is an element of that. You can't disentangle it, but it's basically paper currencies going down. This is actually what the central banks see. The reason that central banks are buying gold is that they're actually selling fiat. And, that is a very important point to understand. Ultimately, when everybody understands that it's fiat going down and not prices rising, and we're not just talking gold at this stage, but we're also talking about, groceries and everything else, then the currency's doomed. So we are on the beginning of that curve. In fact, we were on the beginning of that from 1971, when we started in 71 with $35 an ounce, and we're now close to 3,000. But obviously, the way people think, they're not thinking like so. They're trading it as if it was a stock or whatever, I would personally think that 3,000, there could be some consolidation around about that 3,000 level. It's a view. I wouldn't sell on the basis that it's going to, it's going to consolidate and it might tip back and you might be able to do this, that, and the other. Why? Because if I sell gold, I'm buying dollars. I don't want to buy dollars. For goodness sake, I want to get the hell out of them. And as far as silver is concerned, I think with the gold-silver ratio close to 90, that to my mind is far, far too high. Silver does have a monetary role. There is absolutely nothing in the price for a monetary role at the moment. But I think when you get the collapse of currencies, silver has got two advantages. Firstly, it's, somebody said it's the poor man's gold. I think that's actually, a sort of a reasonable description for the role of silver in terms of being useful for smaller transactions. If you think that the politicians might try and ban ownership of gold, and politicians are stupid, let's face it, when it comes to economics, they are on a completely different agenda. But then you ask the question, okay, if they ban ownership of gold, are they likely to do so with silver? And I think the answer is no, because it's not regarded as a monetary metal anymore. So on that basis, there is some justification for going for silver. And my view is that, traditionally, when you get a rise in the price of gold, silver tends to rise about twice as fast. The problem with silver is that when gold stops rising, it falls, probably not only twice as fast, but it keeps on falling when gold goes nowhere. So that's the sort of problem you've got with silver. But having said that, it's got left way, way behind. And we've had, particularly if you ignore the, selling of ETFs about 5 years ago, silver ETFs, we've had about 7 years of supply deficiency. That's according to the Silver Institute's number.
The conversation around gold and silver has reached a new crescendo, and rightly so. But let me be clear about one thing up front. It's not that gold and silver are going up in some unexpected miracle of valuation. What we're really witnessing is that paper currencies are going down. It's a subtle but absolutely crucial distinction, and when more people begin to grasp that reality, the ramifications will be enormous. This isn't about gold becoming hot or silver suddenly turning fashionable. This is about the inverse. Fiat currency is losing credibility, losing purchasing power, and losing the confidence of the global marketplace. Central banks know this. They're not stupid. They understand perfectly well that gold is not just a shiny rock or a historical relic. It's money. It always has been and always will be. The surge in gold buying by central banks isn't speculation. It's a quiet, coordinated repudiation of fiat currency. Every ounce of gold they buy is fiat they've sold. They're not making a bet. They're hedging against the slow-motion collapse of the system they helped build. Let's bring this home with a bit of historical perspective. In 1971, when Nixon closed the gold window, the price of gold was pegged at $35 an ounce. Today, we're flirting with $3,000. That's an 85x increase in nominal price. But the truth is, it's not that gold has become more valuable, it's that the dollar has lost value. The tragedy here is that the average person doesn't see it. They look at gold as an investment, as a trade, when in fact it should be viewed as a measure, a yardstick, against which the integrity of fiat is exposed. And the public still thinks in those conventional terms. Should I sell at $3,000? Should I wait for a pullback? The problem with this thinking is that it frames gold in terms of fiat, the very system that's unraveling. If I sell gold, what am I getting? Dollars. And what are those dollars buying me tomorrow? Less. That's not a trade. That's self-sabotage. Now let's talk silver. Silver, the neglected sibling in this monetary story, is in many ways the most compelling asset of all. With the gold to silver ratio hovering around 90 to 1, silver is dramatically undervalued. Historically, that ratio has been closer to 15 to 1 or 20 to 1. Even during moderate bull markets, it tends to revert to 40 to 1, 1 or 50 to 1. And if silver returns to even 50 to 1 while gold is at $3,000, you're talking 60 silver, but it likely overshoots. In bull runs, silver always lags until it doesn't. Then it explodes. Why? Because it's a smaller market, because industrial demand is enormous, and because, let's be blunt, it's been manipulated and suppressed more than almost any other asset on the planet. Silver's role as a monetary metal has been systematically erased from the collective consciousness. But it's still there, and in a world where trust in fiat is evaporating, silver will reassert itself. It always does. It's not just about being poor man's gold. It's about being an asset that's both monetary and industrial, tangible and rare, overlooked yet essential. Once silver clears key technical levels, $35, $40, and especially the psychological barrier of $50, you'll see a violent repricing. It won't trickle up, it'll slingshot. But let's dig deeper into what's driving this seismic shift in sentiment and reality. The backdrop, economically and monetarily, is catastrophic. The debt spiral is terminal. The U.S. government has $34 trillion in stated debt and over $180 trillion in unfunded liabilities. At some point, math wins. You can't fake it forever. That's why gold is moving. Not because of geopolitical headlines or inflation headlines, though those matter, but because the underlying arithmetic doesn't lie. And the central banks, they know. They're not buying ETFs. They're not buying futures. They're buying physical gold, bars, tons of it, and storing it domestically. Repatriation is the key word. When Germany asked for its gold back from the New York Fed, it took 7 years. Why? Because that gold wasn't sitting in a vault waiting. It had been leased out, rehypothecated, who knows how many times. You think the central banks don't know that? Of course they do. That's why they're clawing it back now, before the window closes. Let's talk about the COMEX too. People say, look, the premiums are stabilizing, everything seems fine. What they're missing is what's happening under the surface. Share redemptions from GLD aren't about profit-taking. They're about converting paper claims into physical metal. It's quiet, it's opaque, and it's accelerating. The bullion banks, the insiders, they're not waiting for an announcement. They're acting. They're standing for delivery, and not just in gold, silver too. We're entering a period where physical demand is going to blow past available supply. Refiners are booked out weeks in advance. The LBMA is already stretched. Vaults are being drained. You can't fake delivery. You either have the metal or you don't. That's why we've seen a historic collapse in COMEX open interest while price continues to rise. It's a bear squeeze. The banks are trapped. They've shorted gold into oblivion, and now they're trying to escape without triggering a panic. But at 3,000 gold, that panic might be unavoidable. So here's the call to action for anyone paying attention. Get out of paper promises and into tangible wealth. Gold and silver aren't just investments. They are insurance against systemic failure. They are a vote of no confidence in fiat. They are wealth that transcends political risk, counterparty risk, and inflationary theft. It's not about price targets anymore. It's about preservation. You don't need to know if gold is going to $3,500 or $5,000 or $10,000. What you need to know is that fiat is going to zero, and it's doing so faster than most are willing to admit.
And I think it's also been a very managed commodity. I point the finger at China for managing the silver price. Whether I'm right or wrong, I have no doubt that it has been very, very suppressed. And on that basis, I think the suppression has probably come to an end. And I also think that the bullion banks, they're desperate to try and bring their shorts in. I mean, it's interesting, and I think to some extent the sudden premiums that we saw on COMEX, and we saw the price rise something like $200 while open interest fell 75,000 contracts. I mean, that's the bear. And who are the bears? The bears are the establishment. They are being squeezed. And I think they want out of this short position. So that is another factor which is likely to really affect the price. And if we get up to that sort of $3,000 level, then there could be some panicking on the short side, as it were, because it's not really the longs who have been buying futures too much. I mean, I think it's shifted a little bit, because I see open interest on COMEX has risen to just close to 500,000 contracts. I mean, that's not overbought by any means. And we could go another 100,000 contracts to the 600,000 contract level before you say this market is overbought. So, yeah, I mean, I think there's quite a lot of bear squeeze potential still in there. And 3,000 could be a Rubicon, I think, for quite a lot of the bullion bank traders. Interesting position.
Now let's pick up right where we left off, at the $3,000 level for gold being a psychological Rubicon, not just for the retail investor, but also for the bullion banks themselves. What we're witnessing, quite frankly, is the unraveling of a decades-long financial confidence trick. And I say that not in a conspiratorial tone, but as an economist observing the basic mechanics of credit, trust, and value. The fiat money system, which has served as the foundation for global finance since 1971, is now being fundamentally questioned, not in the media headlines, not in the halls of Western academia, but in the quiet corners of central bank vaults where sovereign buyers are accumulating gold hand over fist. It's no coincidence that we've seen persistent weakness in the gold to silver ratio from its peak near 90, now starting to slowly contract. Historically, that ratio contracts sharply in periods of monetary instability. And while silver has lagged, that divergence isn't a sign of silver's weakness. It's a sign of silver's spring being coiled ever more tightly. Now, what happens when the spring snaps? As the paper's short positions unwind, positions that have suppressed price discovery for decades, we could be looking at a revaluation event for silver as dramatic as anything we've ever seen in modern finance. Gold may double from here, yes, but silver could triple or quadruple. Why? Because the float, the actual supply of deliverable physical silver, is so laughably small compared to global demand, especially if monetary demand comes back into the picture, which I believe it will. Let me speak plainly. There is no price discovery in these markets. What we've had is price management. What the LBMA and COMEX have done, through excessive rehypothecation and leveraged unallocated contracts, is simply create the illusion of supply. And this illusion only works as long as confidence holds. That's the crux of fiat currency as well. It is a confidence game. Once confidence breaks, it's not a gradual process. It's sudden. As Hemingway said of bankruptcy, first gradually, then suddenly. We're now in the suddenly phase, and one of the clearest signs of that are the very actions taken by the insiders, the central banks, the sovereign wealth funds, and yes, even the private bullion banks. You don't need them to tell you gold is money. Just look at what they're doing, not what they're saying. As I've mentioned before, these institutions are not buying gold for the sake of diversification. They are buying it because they know the game is changing. For decades, the world has run on the assumption that fiat currency backed by the full faith and credit of governments, primarily the United States, was sufficient. That this architecture, born in the rubble of the gold standard's collapse, would provide enduring stability. But when the debts become mathematically unpayable, and I stress that word, mathematically, the only solution is default. And governments, by their nature, rarely default openly. They default through inflation, quiet theft. This is the fundamental reason gold is being revalued. Not because of geopolitical shocks, not because of greedy speculators, but because trust in fiat is eroding faster than policymakers can paper over it. Now consider the context. Inflation, despite all official messaging, is not transitory. It's not even slowing. We've had multiple months of rising CPI, and the latest annualized numbers point to over 6% inflation. And this is despite the fact that we're being told that monetary policy is tight. It isn't. Real interest rates are still deeply negative. And more importantly, debt levels today, both public and private, are so astronomical that the central banks are trapped. They cannot raise rates significantly without triggering a cascade of defaults across the financial system. That includes sovereign defaults. And so they pretend, they posture, but behind the scenes they prepare. They buy gold. Let's look at the Federal Reserve. Despite all the jawboning about tightening, they have been quietly injecting liquidity into the repo market and continue to hold an enormous balance sheet. Why? Because even modest hikes in interest rates cause major stress in the banking system, as we saw in 2023. They're now boxed in. The solution? Well, if history is any guide, it's devaluation. And here's where the gold revaluation thesis enters the conversation with renewed urgency. There's been increasing chatter from Judy Shelton, from various European central bankers, and from the Bank of America itself about marking gold to market. Currently, the U.S. Treasury values its gold at $42.22 per ounce. Yes, you read that correctly. In a world where gold trades near $3,000, the U.S. balance sheet still pretends it's worth $40. Let's do the math. With 261 million ounces of gold in reserves, a revaluation to just $3,000 would inject nearly $700 billion into the Treasury General account without issuing debt. Revalue to $10,000? Now we're talking $2.6 trillion. And remember, that doesn't require congressional approval. It's a balance sheet adjustment. It's monetary alchemy, and it's entirely legal. Now combine that with a digital rollout, a gold-backed treasury coin, or a blockchain-based 50-year bond collared to gold, as Shelton described. And suddenly you have the makings of a reset, a new monetary architecture, 1 foot in tradition, 1 foot in technology. But either way, gold is at the center. And here's the kicker. This revaluation doesn't just repair the U.S. balance sheet, it does something even more profound. It restores confidence. Because that's what's being lost now globally. Confidence in money, in markets, in institutions. You can't print trust. You can't legislate credibility. But gold is trust. Gold is credibility. And that brings us to the retail investor. Why are they still asleep? Why are they selling gold ETFs while central banks are buying the real thing? Well, some of it is conditioning. Decades of media, education, and financial planning built on fiat assumptions have left the public vulnerable to complacency. The dopamine-fueled roller coaster of meme stocks, tech bubbles, and crypto frenzies is simply more exciting than quietly owning a yellow metal that does nothing until it does everything. But that complacency is precisely what creates opportunity. For those who understand what's coming, this is not a time to chase trends. This is a time to position ahead of the crowd, to own the asset that, for 5,000 years, has never defaulted, never gone to zero, and never needed a central bank to prop it up. Silver, of course, plays a crucial role here as well. Silver is gold's more volatile sibling. Yes, it's the poor man's gold, but it's also the industrial metal with explosive monetary potential. When gold runs, silver sprints. And when silver breaks $50 again, and I believe it will, it could leap to $100 or more in very short order, especially if physical demand collides with tight above-ground supplies and the unwinding of the manipulated paper market. And don't forget the mining shares. Many of the world's top producers are trading at single-digit PE ratios with zero debt and soaring free cash flows. Yet they're completely ignored by Wall Street. Why? Because the models used by analysts are anchored to assumptions about gold and silver prices that no longer reflect reality. As that disconnect becomes too large to ignore, capital will flood back into the sector, chasing leverage to rising metals. In summary, we are not just witnessing a bull market in gold and silver. We are witnessing the end of the fiat era and the emergence of a new monetary order, one that will either be anchored in real value or collapse in a storm of default, inflation, and distrust. The institutions are preparing. The central banks are preparing. Are you? Gold is not rising. The dollar is falling. And when that realization becomes mainstream, you won't be able to buy gold. You'll only be able to bid for it.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.